Today's lecture is on closing entries. I have given you the note. Process of closing entries is the title of the note. So up to now, you have learned how to make entries in journals using source documents and journal, post in journals, meaning transferring data from journal to the ledger accounts, and balance in ledger accounts, and also prepare trial balance. The lessons that we have covered if we have noticed, these are not year-end or closing entries. These are the balancing of accounts during the year. If you are closing accounts at the end of the year, a different approach should be taken. So today's lesson is on closing entries. Closing entries means at the end of the accounting year, how accounts are balanced and transfer balances to some other accounts. That is the thing that we are going to learn. At the end of the accounting year, all temporary accounts are closed, and trading account and profit and loss account will be prepared. In other words, all temporary accounts are closed off to trading account and profit and loss account. Remember, trading account and the profit and loss account are ledger accounts, new ledger accounts that you are going to learn today. Then the permanent account balances are carried forward to the next accounting period. You know the meaning of accounting period? Accounting period is 1st January to 31st December in this country. Right? So that means 31st December, we have to identify the permanent accounts and temporary accounts. Temporary account balances are closed off to trading account and profit and loss account. Permanent account balances are carried forward to the next accounting year. What is meant by temporary accounts? Temporary accounts are revenue accounts and expense accounts. These accounts are maintained in the ledger to find the profit for the year. Therefore, these are temporary accounts. They are closed. These accounts are closed at the end of the year. Balances will not be carried forward to next year. And the permanent accounts are the three major components in the accounting equation, basic accounting equation: asset accounts, liability accounts, and owner's equity accounts. These accounts are permanent accounts. Why? The asset will be carried forward to next year, because we used these buildings next year as well. Your vehicles next year as well. Your furniture, office equipment, we use next year as well. So therefore, the balances of asset accounts, liability accounts, and equity accounts will be carried forward. And the permanent account balances will appear in the balance sheet. And the balances of expense accounts and revenue accounts will appear in the income statement. I am referring to the financial statements. The financial statements include income statement and the balance sheet. So all the expense accounts and the revenue accounts will appear in the income statement. And permanent account balances will appear in the balance sheet. And there is another important thing to note, the drawings account. Drawings account balance will be transferred to the capital account at the end of the year as part of closing entries. As part of closing entries. So how? Some of the accounts are close to trading account. Opening stock is a ledger account and balance is transferred to the debit side of the trading account. And purchases account balance is transferred to the debit side of the trading account. Sales returns transferred to the debit side of the trading account. Buying expenses is an expense account transferred to the debit side of the trading account. Purchases returns, sales and closing inventory accounts will be transferred to the credit side of the trading account. Trading account. It is given in your note, right? In a diagrammatic form, right? Not like this. Whatever the method given, the same thing is recorded in your note, right? Yeah. And trading account balance, because we have debit entries and credit entries. Then there must be a balance. Balance. The balance is called gross profit. It is called gross profit. And then the gross profit is transferred to the profit and loss account. Profit and loss account. So in this diagram it is shown. The arrows are there. So arrow shows the movement of various balances. Then all other expense accounts, balances and revenue account balances are transferred to the profit and loss account. Expense account balances to the debit side of profit and loss account. Revenue account balances to the credit side of the profit and loss account. When we say expenses, by now you know the number of expense accounts. Wages account, rent account, motor vehicle maintenance account, stationery expenses, supplies expenses. All these account balances transferred to the profit and loss account debit side. Revenue, the sales revenue has already been transferred to the trading account. There may be other revenue accounts like rent revenue. You have excess premises, you rented them out and you are receiving rent revenue. And you have invested some money in banks and financial institutions and you will receive interest, that is interest revenue. And if you sell some goods on commission basis, then commission revenue is another item to be included in the credit side of the profit and loss account. Right? Once this is done, meaning transferring expense account balances to the debit side of the profit and loss account and transferring revenue accounts to the credit side of profit and loss account. There must be a balance. This balance is called net profit. Net profit. And net profit is then transferred to the capital account. Capital account. It is not always net profit. There are instances where a business ends up with net loss, right? Net loss. But this is positive thinking, net profit, yes. Then profits and losses, final destination is the capital account. Capital account. For example, this is not there in your note, don't worry. This is to explain. In my note, if you turn to the ledger accounts, right, so you may have seen under this topic some ledger accounts. Some ledger accounts, one side you get balance. Balance. 31st December 2011, balance. What is meant by balance? So that is what I am trying to explain to you. In this class, you have learned only one or two transactions to balance a ledger account. In reality, in real situations, there are quite a large number of transactions per year. And also I said ledger accounts should be balanced periodically. Periodically means weekly, monthly, or fortnightly. It is up to the business based on their number of transactions. Here, just to give you an example, wages expense account. On 31st December, we assume that monthly posting is done. So cash at bank account credit and wages account debit here. Then from where we get this 12,000, this is the total of cash payments journal wages column. You have learned the columnar form journal, cash payments journal. In the cash payments journal, because wages is a recurring expense, therefore we can create a column for wages. Then wages column total. Wages column total is taken and posted to the wages expense account. Monthly basis we assume. Then at the end of the month, January, what we do? We balance this account. We balance this account, meaning you carry down the balance. Then 1st February we have 12,000 in the account. And at the end of February, again we transfer wages column total to the wages expense account. And then again you total it up and find the balance. Carry down balance is 25,000. Then in March, again we transfer wages account total to the wages account. And then again we balance ledger account and carry down the balance. It goes on like this until 31st December. I cannot show everything, but this is just an example. Then we assume that at the end of the year, we have total 144,000. Right? So I cannot give you all the transactions in this small piece of paper, right? So therefore, what I did was, I did like this. Annual total is taken and recorded in the account, all the accounts in this note. So balance 144,000 means this is the total for the whole year starting from January to December. That is the meaning. Right? And I said, expense account balances are closed off to profit and loss account. Then we have 144,000 total on this date, and we are transferring the total to the profit and loss account, and then closed. No more, no balances. The balance is 144,000 that has been transferred to the profit and loss account. Then finish. No continuation, nothing. To continue an account, there must be a balance. If there is no balance, you cannot continue. Right? So this is what I have done here. Okay? Then we learn how to close ledger accounts to trading account. So I have already mentioned the accounts that should be transferred to the trading account. And for closing entries, we are required to use journals. Journals means the general journal, not journals, journal entries to be made in the general journal. Then first step is to prepare journal entries to transfer balances from ledger account to the trading account. So here, this example is given in your note. The following is an extract of trial balance relating to a trading account as at 31st December 2011. So only few transactions. Prepare general journal entries to transfer these balances to the trading account. Then look at the general journal. Sales returns, credit, stock credit, purchases credit, freight inward, buying expenses credit. Because these accounts carry debit balances. So then once you credit it, the balance become nil. And then the total is 86,200. 86,200 is the total of credit entries. We don't have to take one by one. It is a composite journal entry. Composite journal entry means more than one entry is made in the general journal. So 86,200 is not given in the question, so it is the total credit entries. So in my explanation I said purchases account balance is debited to the trading account. Yes, it is debited, right? And freight inwards, buying expenses debited. How debited? By crediting the respective accounts. Then the sales account shows a credit balance, as you know. So then total sales account total or the balance is then debited to the sales account and credit trading account. Purchases returns again same. Debit purchases returns account and credit trading account. Here, this is the total of debit entries. It is not given in the question, not necessary to give. And then the closing stock we don't have an account. Closing stock is obtained by conducting a stock take. Once it is revealed, we will have to make this entry, stock account debit and trading account credit. So it is a new journal entry. Then, here, trading account debit 86,200, trading account credit 140,500, and trading account credit another 9,500. Once you add credit entries and minus 86,200, you will get 63,800. That is the gross profit. That is the gross profit. Gross profit is transferred to the profit and loss summary account. This is the alternative method, right? Alternative method. Now look at the ledger accounts, stock account. Look at the question. It says 9,500 is the closing stock and the opening stock is 7,500. Balance 7,500 is the opening balance, opening stock. And this amount is transferred to the trading account 7,500, credit stock account and debit trading account. Then closing stock, it is 31st December. We found that we have 9,500 worth of stocks. Then 9,500 here, debit stock account and credit trading account. Credit trading account. Once you enter these transactions, still there is a balance of 9,500. Stock account carries a balance of 9,500 according to this. What does it mean? This stock will be carried forward to next year for sale. Brought down balance 9,500. So a stock account, there are dual purposes. One is it is part of the expense account or part of expense and also part of asset. Part of asset. So this is a different type of account. Sales account, total 140,000, it is given here in this question, right? So that is the balance. Balance at the end of the year. Then how do you transfer? Trading account, credit and sales account debit. This is the journal entry we have given earlier. Then no closing balance. Purchases returns, balance 500, that is the amount given in the question. And this amount is transferred to the trading account on 31st December, same day. GJ 80 means General Journal, page number 80. Because this amount is taken from General Journal here, page number 80. Sales returns, we have a debit balance of 1,000 and transfer this amount to trading account and close off the account. Purchases account, we have a debit balance of 75,000 and transfer this to trading account and no balance. Freight inwards expense, debit balance of 1,600 and then transferred to trading account. Buying expenses 1,100 is the annual total and transferred to trading account. So this is the trading account finally. You can see the double entries now. It is more clear than the journal entry. Sales returns debit, opening stock debit, purchases debit, freight inwards debit, buying expenses debit, closing stock 9,500 credit, sales credit, and purchases returns credit. Credit side total is 150,000, and once you deduct the debit side total, you end up with 63,800 gross profit. Gross profit is transferred to the profit and loss summary account. So question is what it says: prepare closing general journal entries to the trading account. Yes, journal entries done. Based on journal entries, we prepared the trading account and prepare other ledger accounts. That means all the ledger accounts we have completed. So this is the way of preparing or making closing entries. In the ledger, you can see the double entries very clearly. Here, trading account 140,000, sales debit, credit, trading account. Similarly, you can check the other double entries as well. Okay, then let's look at closing accounts for accounts to profit and loss summary. Profit and loss summary account. So these are the transactions that were taken from a trial balance. And these items are only related to profit and loss summary. That means expenses and revenues. Rent revenue is a credit balance, meaning revenue. Commission revenue, credit balance. Discount received, credit balance. Staff salaries, debit balance. Discount allowed, debit balance. Advertising, debit balance. Distribution expenses, debit balance. And gross profit transferred to the profit and loss summary account is 63,800, which is a continuation from the previous exercise. So then we have been asked to prepare journal entries. If it is journal, all the revenue accounts debit and total is credited to profit and loss summary account. Right? So these are taken from the question. Right? 5,000, 3,000 and 2,500. Then expense accounts are transferred to the credit side of transferred to the debit side of the profit and loss summary and credit respective expense accounts. The difference is the net profit. Net profit finally goes to the capital account, as I said earlier. Rent account balance 5,000 as shown in your question. Commission revenue 3,000, and all these balances are transferred to the profit and loss summary account. Discount received. Staff salaries expense account, therefore balance is in the debit side. Discount allowed, balance in the debit side. Advertising debit side. Distribution debit side, because these are expense accounts. And profit and loss summary account. Now look at this. Earlier in our trading account, we had a balance of 63,800. 63,800. And this amount was transferred to the profit and loss summary by way of a journal entry. By way of a journal entry. And it appears in the credit side. And all the revenue accounts on the credit side. And all expense accounts in the debit side. And once you balance this account, the balance is how much? 58,300. 58,300. 58,300 is transferred to the capital account, as I said earlier. But capital account is not shown here. We do not know the balance of the capital account because the question doesn't carry the capital account balance. So this is called closing entries. Closing entries. What about motor vehicle account balance? Not transferred to trading account or profit and loss account. It is carried down. Capital account balance carried down. Motor vehicle account, it is an asset account, therefore carried down. All the asset accounts, liability accounts and equity accounts, balance carried down. Carried down means next year we have to open these ledger accounts and start with the opening balance. Okay? And I believe there are some tutorial exercises on this, right? Small questions. Small questions. Yeah, there are quite a number of small questions for you to practice. Then you can learn what I have said. But I want you to concentrate more on ledger accounts than the journal entries. But you must know both. I want you to concentrate more on ledger accounts.